All right, hello everyone. My name is Jason Nicastro. We're going to do the last final panel, which means the last one right before cocktails. Stick around, it's going to be an interesting one. We're going to talk about 2016, where we see opportunities for investments, both in stocks, bonds. We're going to talk a little bit about REITs. So with that, I'd like to introduce the panel. Carl, maybe you can kind of give overview of who you are, what you do, and the process that your firm does.
Carl Snyder. I am with Garden State Securities. I'm Chief Mortgage Strategist.
Is this question number one? Is this question number one?
We're RIA, Registered Investment Advisor. Obviously, I don't need to tell you guys that. What we do is wealth management with a little overlap, financial planning and asset management, predominantly with high net worth individuals. Really haven't made an entrance into working with institutions. So that's the background of the firm. And what I do is portfolio modeling, management, set forth some of the thought leadership for the firm, help with guys with their idea thesis, and then we'll talk directly with individual clients of the firm, trying to help them navigate their obvious goals and walk them through the portfolio management theme and what we're looking at.
Carlos?
My name is Carlos Diaz. I'm the CEO and founder of a company called Market Grader. We do two things. We are an equity research company. We cover about 35,000 stocks globally. And we are also an index publisher. We publish about 50 indexes, all fundamentally selected, equally weighted. So what a lot of people refer to now as strategic or smart beta. And so we are best known in the US for the Barron's 400 index. All our indexes and the methodology that we employ in grading all the companies that we rate and in selecting all companies in them is a GARP methodology. So we are a growth at reasonable price shop, so to speak. All our ratings are fundamental in nature. So that's essentially what we do.
Joel?
Hi, my name is Joel Wells. I'm a portfolio manager at Alpine Woods Capital in Purchase, New York. Alpine is a privately held family of funds, primarily mutual funds, long only, that has specialized strategies in equity income products, real estate, infrastructure, and some small cap and financials. I'm primarily I'm a senior team member on the real estate side of the funds. Alpine is known as being the oldest and first international real estate fund. We started in 1989. So we've gone through a lot of cycles, a lot of ups and downs within the real estate space. And primarily our investors, we have some retail, some institutional, and that's the focus.
My name is Jim Pritchard. I'm with W.E. Donahue. We're a money manager based out of Boston. We're a tactical money manager, and we specialize in seeking to avoid large losses for client accounts. So we have been in the business since 1986. Our first tactical fund was in 1998, and we had the pleasure of teaming up with S&P and Dow Jones custom indices to create one of the first indexes that is smart beta. It combines dividends and equal weighting with a tactical buy-sell signal, which I'll probably get more into in one of the other questions from the moderator. But I wanted to just make a quick comment. How many of you wanted to find out if Mr. Wonderful was like he is on TV? So I actually, I did. My wife Kim did. We were real interested in going up, shaking his head, and seeing, well, is he a good guy or not? He is one of the nicest guys I've ever met. I was very, very pleasantly surprised, and I thought that was pretty cool. And those guys have a great product.
Awesome, thank you, everyone. So as you can hear, we've got some top-down focus, some bottom-up, stock picking. It's going to be a pretty good dynamic in terms of where we see opportunities. We're going to cover all the different areas, but you're going to get different perspectives as we go. So let's start with the U.S., domestically focused. Carl, kind of give your view, high level, what you see opportunity-wise. Is U.S. stocks a good place to be, and if so, where are you looking?
Yeah, as far as looking at the U.S. markets on, 30,000-foot view, just using the S&P as our proxy, that's really what everybody's going to use, right? I think I tend right now to favor large cap. I think it's going to continue to do well. We had that really mini crash August, whether you want to call it a mini crash correction. So a lot of things did break technically. Just a little quickly about my background, even though I'm an asset allocator, strategist, I'm also a CMT. So sometimes I go off on a tangent on technical. So if I do, sorry. So a lot of technicals broke. We had a Dow theory sell signal over in August as well. However, that resolved itself fairly quickly. Not so quick that it was just a bear market bounce or a dead cat bounce. I think that we've had enough time healing because sometimes within corrective modes, it's not just necessarily about how far the correction goes. We're looking at, can be taken up with time. So the vast majority of 2015, we basically were range bound, had a breakdown, thought that may continue, looks like the markets have established themselves. So I tend right now to favor technology. I think right now, the US, I do a lot of relative strength work too within my asset allocation models. So if I say that something's outperforming, that means on a relative basis, and then I'll also look at some momentum factors as well. But large cap US stocks, as S&P as our gauge, are outperforming the rest of the world. And on an absolute basis, we're flat for the year. But again, I think if we look over the long-term trend, the trend has been up. So what I do find are certain sectors within the market that I particularly like right now. I like technology. I think large cap tech, specifically information technology, will do well. As we talked, a lot of people were talking on earlier discussions about how technology is phasing out the middle class. So whether you agree with that, don't agree with it, let's face it, technology is going to continue to grow. Information technology, I think, is a good place to be. Also, right now, when I'm looking at my sector work, I'm seeing industrials do quite well right now. And I think also, we talked earlier, well, I didn't, but we had some talk earlier about retail. Retail's been taking it on the chin, but a lot of people don't realize 70% of the economy is the consumer. Out of that 70%, only 3% of that is shoes and apparel. So consumer services sector, I like. Talking leisure, other opportunities. So if you want to take a look at the Dow Jones Consumer Service Sector Index to kind of be your proxy, I like that space quite a bit right now. And if, this is a big if we get interest rate rise by the Fed, that should benefit financials, more specifically the banks, lenders. I would look more at regional banks. They stand to benefit as they're going to start making those margins on the loans. They then should start to perform well.
Perfect. So, Carl, you'd mentioned about, things kind of sold off and broke, but you're pretty bullish for the most part. Jim, you have a downside risk model too, right? That determines if you're going to be in or out. What's that saying now, and what have you seen?
We have, as I mentioned earlier, we built an index that creates a signal. It's an overlay on our index based on momentum that will move to cash to avoid large losses. So this index back-tested back to the year 2000, 100% math-driven, high dividend yield, equal weighted, all the things that Kevin O'Leary mentioned earlier. And it has gone to cash 5 times since the year 2000. The most recent was July 24th. And we're still sitting in cash. So it was, sometimes I've looked at the signal is, again, momentum-based. It's all technical. It's all based on math. And in 2000, 2008, the signal was a precursor to the market dropping by about 6 months. It underperformed. Same thing recently. The signal underperformed. High dividend stocks underperformed from about mid-May till July. Our signal crossed. We went into cash. So we're still in cash. The market keeps going up. We're close to crossing back over on our exponential moving average crossover signal. And if the market continues up, we'll ride the next wave up. If it goes down from here, if it can't get through this resistance and bounces back down, well, we're in cash and we're protecting our client assets. So that's what our main goal is. And my main mantra, I found a book recently by a couple guys in San Francisco called Win by Not Losing. And it's by Nick Atkinson and Andrew Houghton. And the premise is to build a portfolio with strong downside protection. And I believe in that 100%. If you can avoid those big losses in your portfolios, then you can have great compounded returns over a full market cycle. So we're a long-term manager, full market cycle minimum.
Perfect. So a little bit of a kind of mix, macro view and technicals, quant. Joel, tell us about what you're seeing in terms of your more macro views in the U.S.
We're long-only macro portfolios, primarily focused on real estate. At least that's my side of the business. We run global portfolios, and right now we're neutral on the U.S., but the U.S. is a pretty big component within a global portfolio in real estate, about 40%. So we are in the REITs, and we feel like the REITs actually are going to continue to be a very interesting place. They've been weighed down a bit this past year just on uncertainty on rates, and I think everybody has been holding their breath, waiting for a little bit more certainty and clarity, at least on the path and the trajectory of interest rates going forward from the Fed, or at least language from the Fed. We think REITs have a lot of things going for them. First of all, they're not that expensive right now. 16 times FFO, 4% dividend yield. You're not getting in. Right before the taper tantrum, there were high valuations. You saw a reset. Right now, they're trading at or below fair value, about 10% discount to NAVs. Secondly, there's still a very large bid for real estate in general in the U.S. and globally. And so if you look at cap rates that we're seeing on commercial assets and retail assets within the U.S., they are still being driven down. There's still some compression in the system. There's a lot of capital still chasing assets. The listed guys are trading at significant discounts to private market transactions. So that provides some support going forward. If you look at just the amount of capital that is looking, so far to date in the public space, you've had about 150 billion of transactions taking place just in the publicly listed guys. The private equity guys sitting on the sidelines have about 250 billion. You lever that up, that's 500 billion. And so there is still a lot of money out there chasing assets, and so you're going to continue to see some compression. The thing that's been hanging over the REIT space really has been rates and the direction of them. And that's always going to be a discussion about the impact of rates on REITs. If you really look back and do some empirical analysis, what you're going to find is that moves by the Fed are not really predictive on rate direction. What is predictive is 10-year treasuries and where those are going to go. 10-year treasuries, cap rates tend to follow where the treasuries are going. So the question now is what you expect to happen on the long end of the curve post the announcement on the 17th. On the 16th. Our view here, at least given the data that we're seeing right now, is that you're going to see a little tick up on the short end, a little bit of flattening on the curve. REITs may get hit just as a reflexive thing as people are trying to parse out exactly what the Fed has been what the Fed's intentions are. But we think once that correction, if it were to happen, it would be a very, very strong buying opportunity.
Perfect, thank you. And then from the bottom up, Carlos, your company, the Barron's, essentially grades stocks, looks at what are the best ones and puts them in that portfolio. What are you seeing? What are the opportunities? What stocks have been bubbling up?
So a couple of things. First of all, we're still very constructive on U.S. equities, but maybe I'll touch on that a little later when we talk about different markets. But so we're constructive on the U.S. and U.S. equities, still are. And within U.S. equities, we've been seeing a pretty interesting dynamic across three sectors primarily as far as our grading goes. So Like Jason said, we have a bottom-up selection process. So we're looking at a company from a growth and a value and a profitability and a cash flow perspective. So when you aggregate all those, you get a pretty comprehensive quality score. That's also part of our GARP screen. That being said, when we build the Barron's 400 index, for example, which is our broadest index, it's equally weighted, we have a sector constraint of 20% or 80 names. So no more than 80 names in the index can go into one sector. We do this twice a year when we rebalance the index, and here's where the interesting dynamics come in. Financials in the last rebalance, which happened in September, reached that cap of 20% for the second time in a row after it had done that also in March. Never before in the history of the index, which has been around for about 10 years, has that happened. So what that means is we're seeing a significant amount of fundamental improvement across financials in the United States. We see that mostly in, we see it across regional banks, we see it in insurance companies, investment managers. So it's pretty broad based fundamental improvement across financials. So that's one theme. Another one is ongoing strength in industrials, which I think is something that gets underreported regularly, because when people talk about industrials, they tend to talk about some of the companies in the S&P, some of the larger multinational companies, very exposed to international markets. We do own some of those, but where we see a lot of strength in industrials is in the mid-cap space. There's a lot of companies in the US that are in the 1 to 10 billion range in market cap. That are a lot more exposed to a strong US dollar because they're more exposed to the US economy as opposed to some of the larger multinational companies. So there's an ongoing theme of strength and growth across, also it's pretty broad across industrials. So, and then the third theme on a sector basis is something that Carl mentioned before and then Jason mentioned after the lunch break. We see a significant shift in consumer discretionary. So consumer discretionary is probably the largest or one of the two largest sectors by component count in the U.S. Investment universe. So we used to see a consistent reaching of that 20% cap in the Barron's 400 among consumer discretionary. That has been eroding over the last year and a half or so. So it's still we still have a healthy allocation to consumer discretionary, but it's not the names that you would suspect. There's been a significant rotation with consumer discretionary. So same theme that was discussed before. More of certain services, consumer experiences over consumer discretionary names such as retailers, apparel companies, and so forth. So that is also pretty clear, at least from the bottom up, as the way we see it within the Barron's 400.
So we heard financials, industrials, consumer, large cap, mid cap. I take it, Jim, once your signals turn, we should all be pretty bullish.
Right.
It's a lot of areas of the market to like.
Send me your email, I'll let you know.
Let's move over now. Before we get international, obviously something that's a big part of that is what's going on with the dollar. So book a vacation and leave now, or is their dollar going to be a little bit stronger? Carl, why don't you give the first crack at it?
Sure. I've been bullish of the dollar for quite some time. In August 2014, the dollar broke out. What I mean by breakout from technical levels, it had been in a downward mode, a lot of consolidation, trying to form a bottom. And when I say the dollar, I'm using the currency basket, the DXY. Okay, so to be clear. And when it broke above 81.50, 82, the dollar Dixie, if you will, really went on a tear. Within 7 months, it was appreciated more than 20%. That's not a normal occurrence. There's something signaling there. My belief is now we have entered into not a cyclical, but a secular bull market for the dollar, which I don't think ends right away. Now, in March of 2015, the dollar peaked right around 100, okay? So during that time, it needed to digest that move. When you have a currency, and I'm not talking about some small obscure currency, I'm talking about a large currency that shows that type of strength. That's a large move to digest. So again, time digested that move. We went, and just till recently, dollar really basically trading in a range, DXY of course, and then most recently broke out again, trying to hit up against resistance at 100. So what does all this mean? My point is, I believe that we're in a long-term trend of dollar strength, which I think will continue, and I think, you know, most of the time when you have a currency move like this, the secular move is years, not months or weeks. So I'm strong, I'm bullish the dollar. I don't think it's going to appreciate 20% again like that, but I think the next leg is up. And just to kind of then circle, what does all this mean to your investing? Personally, again, factor-based ETFs, et cetera. If you're going to have exposure outside of the US, my view and the view that our firm has, and I've been telling our advisors to do, is to hedge your currency exposure. That's my belief. I continue with that belief, and I'll stick with that. So if you want to have emerging markets, developed markets, I believe that you should do that with a currency hedge. Otherwise, dollar strength could accelerate a lot more than I anticipate, and any move in that underlying index, if you're using the regular vanilla ETFs, that performance in that market that you're trying to capture is not going to be captured. If anything, it may even be eroded.
Perfect. And Joel, you take your firm obviously has a global view. What's your view,
Sure.
A, on the dollar, and then internationally? What do you see for opportunities?
Well, on the dollar, I have full agreement. I think Carl's spot on. We look at it, we come at it from a bit of a different angle, though. I mean, our view on strength of the dollar really comes from macro and policy divergency. So if I think about the U.S. now going to get off the zero bound for the first time in 6 years, we've already seen the dollar start to anticipate that, and that has been somewhat responsible for the move relative to the basket or the DXY. We then look at the other currencies, so the main trading currencies of the euro, the Japanese yen, the British pound. We expect to see dollar strength against the yen, against the euro as well, because they are going to be fighting off the disinflationary forces by doing everything they possibly can to depreciate their currency. So you're going to see dollar strength against those assets. So if you're investing in, my view would be if you're investing within developed markets, particularly Japan and in the euro, that you make sure you have some hedges in place. The pound is a little different. They will probably be entering a rate cycle shortly, if not in the spring, sometime in late next year. Once that does happen, I would imagine the pound could realign. The problem you have with the pound is whether the UK decides to leave the European Union, so the so-called Brexit. That's some geopolitical risk that always has a taint on FX movements, particularly in the short term. So we too feel that the dollar is strong. Our overriding concern, and one that you really need to consider, is how the Fed ultimately reacts to dollar strength. We saw them speak about it earlier in the meeting in the springtime, where they weren't explicit about it, but the point was we have our eyes on dollar strength and we understand the implications for dollar strength on the recovery in the U.S. Very important to keep an eye on that. It has a lot more bearing on Fed policy than it should have or than you would expect it to have. As far as international goes, we think there are opportunities on a hedged basis internationally. The dollar is going to be strong across the board. Trying to think of a currency that is going to have some strength against the dollar, and it's difficult to find one. So, but on a hedged basis, we think there's great opportunity. We look at it from a top-down, bottom-up perspective, and from the top up, we're looking at what I would call axes of differentiation. Whether a country is a commodity importer or commodity exporter, whether the country has fiscal and monetary room to adjust and take care of the economy, or whether they do not have that type of room. We have many axes within our framework, but those are two that are germane to the topic of FX. And so in that respect, we like Japan, we like the euro, we think they're going to be the first week of December, we're probably going to see language come out of the ECB where they're focusing on a further shift in monetary policy, which we think is going to help get them off that deflationary track and weaken the currency. And Japan the same way. Kuroda and Abe, we think, are committed to lifting them out of 20 years of deflation, and so we're playing those markets where asset reflation is going to be a theme.
Perfect. So constructive on the top-down view. Carlos, from what the signals are telling, what your scoring system says internationally, where are you guys seeing the best opportunities?
In the developed markets, I actually don't like any developed market as much as I like the U.S. I think Europe and Japan would have good percent opportunities in 2016, but I think they're short-term. I think they're to be played more tactically, simply because we don't think that the structural changes that need to take place in those countries or regions have actually taken place. So in the long run, I don't think that's very conducive to further growth in those economies. On an isolated basis, you could see some strength in certain places among those regions, but overall, I would say still more of a tactical play. So if it's about an allocation to developed markets, I think there's no better place for long-term capital than the U.S. And then in the emerging markets, I like China a lot. I like China's domestic market, meaning their Asia market. Our firm's been doing a lot of work on the China-Asia market, and we think that a lot of the headlines that we've been hearing about the rebalancing of the Chinese economy away from heavy industry and resource-based growth toward consumption-driven, service-driven, high-value manufacturing and so forth is actually playing out at the corporate level. You can actually see the earnings growth accelerating among some of those names. There's significant earnings growth in healthcare names in China. There's significant earnings growth in certain sectors of technology, certain sectors of consumer discretionary, consumer staples. The problem for us as investors is access, of course. It's still a pretty closed market. I think that won't be the case for too much longer. I think it's going to be a pretty open capital market within the next year and a half to 2 years. So if an investor has an opportunity to position themselves in anticipation of that, I think that would be a very wise long-term investment. I think any way you look at it, China over the next 5-10 years is a place that you would make a mistake not to be invested in. So we're very constructive on China and the U.S. Those are our two main themes.
Jim, want to add something?
Yeah, we also have an international index which combines some European stocks with some emerging market stocks and major international corporations. But we think that if the ECB continues its accommodative stance, that we should see some strength in Europe. But we also believe that in the case of commodities bottoming out, if commodities bottom out, that strength should be stronger. And we feel that way with the emerging markets as well, that the commodity markets need to see a bottom. And our strategy is based on momentum signals. So if we can see those things happen and the markets show some momentum to the upside, then we think that would be a good time to get into the international scene. And until that happens, we're in cash, actually. We went to cash a couple months ago. We're still in cash again in the international markets. So we need that market to show a certain amount of momentum before our signals cross and we move into it.
Thanks, Jim. And I also wanted to ask you, we talked a little bit about rates, right? And the fact that the rates are probably going to be going up. We're going to see the Fed raising rates likely in December, if not early next year. You also focus on dividends, right? Dividend yielding companies. What impact, if any, have you seen from kind of your research? Is dividends an area of investment something we should be worried about?
Well, I've heard a lot about the fact that when dividends go up, dividend stocks aren't going to do as well. And so when I started hearing that, I looked into how our domestic power dividend index performed. And I passed these out. You should have this on your table. This is the actual index information. So I looked at from when this index started. Obviously, rates have been coming down, but as you know, rates have been coming down since 1981. They don't come straight down. There's pockets of rising rates in a downward trending market. So There's a couple periods of time when rates ratcheted up about 2%, and by rates I mean the 10-year Treasury. So 10-year Treasuries went up, I think it was June of '03 to June of '07. Rates went up 2%. The power dividend index actually was up 80%. And similarly in 2000, let's see, the end of 2007 into 2008, interest rates rose a couple percentage points. And again, the power dividend index did very well in that period of time. So I'm not so convinced that a rise in interest rates is going to affect dividend stocks negatively. And also we think that at this point, rising rates are kind of built into the pricing. We've all seen that in the last week. Prior to the Fed saying, hey, we're probably going to raise rates in December, anytime an increase in rates was mentioned, the stock market obviously took a pretty big dive. And lately, just this last week or two, they actually said, hey, that's good news. We want to see rates go up. We don't think rates are going to skyrocket. We think there's going to be a slow increase in interest rates. And to get back to that dollar story, that increase in interest rates will help strengthen the dollar.
Going along with rates, let's switch over to fixed income. Carl, in terms of the fixed income areas, where are you seeing opportunities?
Within fixed income, the way that I approach fixed income, we just had a great panel before talking about closed-end funds, different types of strategies, and quite frankly, that's a little bit out of my wheelhouse. So I would implore, strategies like that. When I look to fixed income as an asset allocation tool, what I use as a reference to begin with is both the long bond and the 10-year. So going into the point of what Jim just said about Fed funds rates are going to rise, okay? It's going to be about the trajectory and the rate of change of how far they rise. But going back again, 30 years, rates have been in a bear market, so bull market for bonds, right? Not overnight, you're not going to overnight have rates run away on you. It's just not going to happen. You look at historically, rates bottom over a long period of time. So I guess what I'm saying is my proxies for fixed income right now is still using treasury bonds. You could look at the whole aggregate bond index. It's not performing that well. And even treasuries, which we have some exposure to because it's part of the asset allocation model, we're long the long bond via TLT or other products that you could potentially use. So I think that still wants to be a part of your portfolio. I mean, you could get exotic, and sure, if you're trying to get a certain type of strategy, but that's not what I personally do. I'm looking at the asset allocation models. If there's a product that can solve the problem for me, by all means, I'll look at it. But I want to look at the big picture and say, okay, fixed income, treasuries still have an allocation there. They help to diversify some of the risk within your portfolio. It's an asset class. I think that you should still be long now, depending on your risk objectives. But looking at different ways to try to hedge out interest rate risk and such, that's not really in my wheelhouse. So that's something that I won't touch on because I wouldn't be a good expert at the expert series for that, okay?
Thank you. Joel, your views globally, for the fixed income portion of someone's portfolio, where do you see opportunities, both domestic or abroad?
Yeah, I'm going to have to, again, I'm no expert on the fixed income side. I do want to follow up something on the EM a bit, because
sure.
Emerging markets is something that we do pay very, very close attention to, and I would tend to agree with you. I think China is an opportunity that should not be discarded out of hand. We look at differentiation again within our EM portfolios and see significant opportunity. 6 years of sequential downgrades in earnings are going to have to bottom out soon or shortly, in our view. China, we again on the axis of differentiation, we're looking at countries that have fiscal space, monetary space to encourage growth, and we believe China is probably one of the strongest governments in that regard, and you're seeing it already. They're in the midst of an enormous transformation from from that investment-driven growth to a consumer-driven growth. They're also, very importantly, are in a process of de-dollarizing their balance sheet. And that's going to be a difficult and painful process. But we're seeing small moves here with the SDR inclusion for the currency. We're seeing more renminbi being put into the global economy. And so slowly but surely, they're going to become a much, much bigger player on the global stage, and I think that will be to everyone's benefit.
Perfect. And then in terms of commodities and energy is obviously a hot topic. Carlos, maybe from your point of view, have you seen any improvement overall or less improvement in terms of the energy sector? Something that's been beat up for a while now?
Not a lot, actually. I think there are opportunities across the energy space in the U.S. You have to be very selective. Capital structure is very important, but everybody knows that, I think. As far as our index allocations go, materials and energy are the two smallest allocations in the Barron's 400. Energy is about 4%. And in the latest rebalance, we saw basically the couple of E&P companies that we still own basically got kicked out of the index and got replaced by either downstream or midstream companies. So we have just a handful of names, and they're just a couple of refiners and a couple of companies in the infrastructure space. So I think there's value in the infrastructure space, and there will continue to be value in it. But I still think selectivity is very important in the space. So that's, and I think overall economically, it's going to continue to, low energy prices. If you're not in the energy space, but as far as the rest of the economy goes, it's going to continue to be constructive for U.S. consumers, for the U.S. economy overall, for U.S. industrials. So from that perspective, it's one more reason why we are constructive on the U.S.
Joel, Carlos, I saw you both nod your heads. Joel, do you agree?
Well, I certainly agree with the infrastructure comments. I think infrastructure, particularly across the board, you're going to see very little differentiation for the need for infrastructure, whether it's in a developed economy or a developing economy. Extraordinarily important. Supply side constraints are dampening economic growth across globally. And so to the extent that we are going to see government partnerships, we're going to see private sector incentives to invest in infrastructure, it's going to be a key growth area globally for the next, especially as rates remain low. We're not going to see a big spike in rates, at least in our view. And so as those rates are low, you're going to see some very attractive returns coming in through the infrastructure space.
Carl, energy infrastructure, any comments?
Sure. If I could kind of dovetail energy into emerging markets.
Sure.
So with emerging markets, you have the haves and have-nots really too. That's how you get your emerging market exposure as well. You're going to have your producers, your commodity takers, your commodity makers. So you look at countries that import a lot of and are very intensive for their manufacturing purposes. You're going to look at countries that import any kind of commodity, really. Look at, you could use crude, we're talking on that, but any type of commodity, coal, iron ore, you run the gamut, all commodities are depressed and continue to be in serious downtrends. So for emerging markets, what we could do is say, all right, let's look at the countries that are not reliant on exporting their natural resources. Let's look at countries that are going to import our natural resources. That's why I personally like, so one of the main themes of asset allocation, you're gonna have your emerging markets, but they don't look well to me. So I will start to get, that's when I'll start getting granular. One particular country I like is Vietnam. I think they're a big manufacturer. They're the largest export destination of their goods is the US. So US currency being strong, we could import more of their goods. This should be good for Vietnam. To that point though, I think that oil prices, no one's gonna really be able to say which way they're going. I know they're in a downtrend and they're continuing to be in a downtrend. It's gonna take a lot to get oil prices to round up and bottom out and to start their, either just to base, go up higher. So emerging market, Mexico. I do like Mexico. Mexico's a catch-22 though. Even though 80% of their exports come to the US, which is good for them, the vast majority of their exports are petroleum products. Not, one would think it's a lot of manufacturing, so it's not. So I think a lot of that's priced in, though, that the energy prices are going to stay low, because if we look at the Mexican market, we can see it's trading pretty close to highs. It's been in a range bound for, over a year, within a couple, and in case you don't know, we're talking that the bull spot there trades right around 45,000. So when I say it's 2,000 points, it's not like saying the S&P 2,000 points. So it's been range bound. So I think we want to be cognizant, look to, not Brazil, excuse me, look to Mexico. But again, I'll go rely a little bit more on my technical analysis a little bit and say, when I see that breakout and the continuation of that market, that's when I'll get long and want to be there. But I would definitely put Mexico on my radar.
Mexico and Vietnam. Joel or?
Yeah, I think Mexico is a great call. Vietnam's a little difficult for a U.S. investor. I mean, I think the thesis is very solid, but from a U.S. investor, it can be a little bit difficult. They're slowly opening up that market, so there will be some great opportunities there. The ownership structures are just a little fuzzy, so be very careful when you're looking into that. Mexico, obviously, it has the best of both worlds. It's an emerging market economy that has its largest trade partner as developed as the U.S. So we are very, very constructive on Mexico. I think as they shift away from that energy and the reforms that they're trying to implement, albeit slowly, are to help make that shift. They are now becoming sort of end producers of for multinational companies, whether they're car companies, airlines or airplanes, et cetera. So it's going to be a slow shift, but one that bears watching. The other economy that I would throw in there is India. The reason I would say that is because we just saw the new central banker came in September, about a year and a half or 2 years ago now. That really started the reform process in India. Then Modi is elected. He has ignited a reform trend in India. It's slow, it's difficult to move, but it is going to be productive. You have 7.8% GDP growth coming in India. You have a very well-educated population. I think that, or we believe that India is going to be the next real growth market over the next 5 years. Right now, it's trading a little expensive, just because people have been quick to realize this. I think you pick your spots, but over the long term, you're going to be very happy that you looked at India.
Carlos, any thoughts on India, Vietnam, or Mexico?
Sure. Actually, I have a bit of a love-hate relationship with India from an equities perspective, because I think it's a country with such potential, but it's always an unrealized potential. I think from the equity market perspective, I think it's only, if you take it just as a single country, I think it's, in terms of the number of listed issues in India, I think it's second only to the United States as far as how many companies are listed. That being said, it's a very, very shallow market. A large amount of the liquidity is in the top 20 to 30, maybe 50 names. Once you fall below that, the drop-off is significant. So, if you're thinking about allocating, if over time capital flows were to be conducive to allocating more capital to India, it's going to take a little bit of time for significant amounts of capital to flow there for the reasons that I described. That being said, I do think that a lot of the reforms underway are constructive and could be significant. I think the judges still out as far as how effective that's going to be. A lot of the special interests in India are very well entrenched, so it's going to be very hard to dislodge those. So, and as far as other markets go, I like Mexico as well. I like Vietnam also. I think emerging markets need to be looked at, like Carl was saying, on a kind of like case-by-case basis. I think the period of just investing just in blocks of developed or emerging is kind of over, and I think it's important to be selective, and it's actually a good time to be doing that because you can really start seeing differences across markets. I think if you look at emerging markets, it's pretty simple. You stay away from companies that have current account deficits and stick with countries that have current account surpluses. I think after the late 90s Asian crisis, some countries knew what they needed to do, so they deleveraged, and whatever leverage they continue to accrue or still had, they shifted it from dollar-based liabilities to domestic liabilities. So that's fine. Some did not do that, and some continue to have large dollar liabilities, and now they're struggling with what happened with commodities, what's happening with the dollar. So capital flows out of those places, and it's very difficult to be constructive on them. So you start to see differences between the Indonesians and Malaysia, for example. China, domestic versus China outside. India, some of the other Southeast Asian economies. So in South America, a very good example of that is Chile and Brazil. I mean, they're size-wise, two very different economies, but Brazil rode this huge boom in the 2000s based on commodities, and they were a huge resource exporter to the rest of the world. And what they did is, you hear about how many people Brazil moved out of poverty into the middle class in the 2000s, which is true, but a significant amount of that was transfer payments. So it was really not a lot of economic growth, and we're seeing now the hangover from that. Now they're in a very poor condition, whereas Chile, which is also very resource-oriented and dependent on resource, especially copper, which is basically rolled over along with the rest of commodities, actually built a pretty significant rainy day fund, which when things were riding high, everybody wanted the government, tap into and start doing social spending and so forth. They did not, and now you're seeing a much more stable economy actually becoming an exporter of capital to the rest of the world. So it's just one more example of the need to be selective across the emerging markets, and there's an opportunity to make money in some of them. I agree.
And last but not least, Mr. Cash, internationally, emerging markets, time to be in?
Not yet.
Not yet.
I do want to, before I make a comment, I want to make a correction. When we were talking about rising rates, and I think I misspoke, the Power Dividend Index did very well in a period of rising rates from December of 2008 to April of 2010. Rates went up 2%. Power Dividend Index was up about 50% during that period of time. I think I gave the wrong dates. But again, because we are fully tactical, and we will only go into a particular market when our signal crosses, and we use exponential moving averages, proprietary signal. We are in cash, and we will only go into those markets when our signal fires. So I guess that's all I have to say about that.
So for the most part, pretty constructive from the group. Just waiting on one more signal, and we'll be good to go.
That's right. That's right. So, sorry, guys. We got to wait. We got to wait. And another thing I'd like to say before we finish, because we're almost done, right?
Yeah.
Is I've been wearing a blue shirt and a yellow tie for a while, and I'm trying to start a trend, and I see a gentleman in the back that has jumped on the bandwagon. So after, more of us start wearing these, then everyone should buy blue shirts and yellow ties.
Okay.
That's a signal for you.
It's a signal.
The momentum will be going up.
That's how the signal works.
Yeah.
Proprietary.
All right, well, thank you. Thank you to the panelists. Thank you to the audience. I'm going to turn it over back to Chris.